I'm not really very good at that sort of thing, at least not the way they wanted me to be. And so I failed the test, and I still have the assessment report, which I keep framed because it essentially says I have no ability and no aptitude for the investment business. So needless to say, that pissed me off.
All right, ladies and gentlemen, welcome back. This is SimCast episode number 20, and I have a really special guest with us today. This is Gil Morales. He is a former Chief Market Strategist for Bill ONeil, William ONeil Company. He is also a prolific trading author, and one of my favorite books, In the Trading Cockpit with the ONeil Disciples, taught me all about pocket pivots and buyable gap ups and all that good stuff. So, it's a real pleasure to have you here, Gil, and welcome to the SimCast.
Thanks for having me. Nice to be here. Although I'm at home, but you know what I mean, virtually.
Yeah, welcome virtually to the SimCast. How about that? So,
very good.
Well, listen, why don't we get started? Tell our viewers who may not know you. I obviously know you because I followed you ever since about 2018, 2019, and have actually studied under you, consider you one of my mentors in the market, honestly. And
I'm honored.
Yeah, no, well, I'm honored to have you here. So, maybe step us back a little bit and tell us how you got started in trading and worked your way up to, those positions that you had with Bill ONeil.
Well, I started in the business in the early 90s at Merrill Lynch as a broker. And basically, I just wanted a job. I was broke. I was in debt. I was about 31 years old. And I had been trying to be a professional cartoonist and a graphic designer, illustrator, which I was doing, making some money at it, making a living at it, but not a great one. And so one day I chanced into an office of Dean Witter. I don't know if you remember the old Dean Witter firm. They were bought up, I think, by Morgan Stanley, I forget. But in any case, I went to the to this office of Dean Witter to go do some graphic work. And the manager there, we struck up a conversation, and after a while, he said, I think you might do pretty well in this business. And so we started talking. And so I applied to become a broker there. And I took a basic test. They give you a broker test where you go on a telephone and they have these actors pretending to be clients and blah, blah, blah. And you're supposed to sell them on stuff. So, I'm not really very good at that sort of thing, at least not the way they wanted me to be. And so I failed the test, and I still have the assessment report, which I keep framed because it essentially says I have no ability and no aptitude for the investment business. So needless to say, that pissed me off. So what I did then is I said, all right, you know what? I've kind of made up my mind. I want to get into this business. I'm tired of being a broke cartoonist, artist, wannabe. And so I went over to the Merrill Lynch office nearby in Pasadena, and I took their financial aptitude test. And I have an econ degree from Stanford, so it took me 10 minutes to take the test. And the assistant to the manager was, saying, "Wow, that's the fastest anybody's ever taken the test." Like, yeah, well, it's not that hard. And she said, "Well, the manager won't be here till next week. He's on vacation. He'll interview at that point." So again, my OCD personality took over. And I was still ticked off about being told that I had no aptitude by Dean Witter. So I went to the Merrill Lynch office, and where I figured all the money was, and that's Beverly Hills. So I walked into the office one morning around 6 a.m. and told him I wanted to speak to the sales manager. And he was in early, and there was nobody really there yet, but I figured I'll get there as early as possible. And so I got a meeting with him. And so he thought he was going to get rid of me pretty quickly by asking me what I suppose is a basic question that they would ask broker trainee applicants, which is, what do you think a broker does? And of course, a lot of people would say, well, a broker helps people do their financial planning and, allocate their investments. And well, if you answered it that way, you're out the door. I just looked him in the eye and I said one word, and that was sell. And he got a smile on his face. And so we went upstairs and talked to the big kahuna manager of the Beverly Hills Merrill Lynch office. And he started giving me a bad time. And I basically told him F you and few other things, and he liked that. And so he said, okay, we'll hire you. I guess he just liked the fact that I was so headstrong about it, because I guess in sales, you do have to be headstrong. And so I got started. I started Merrill Lynch, and I did reasonably well there as a broker. So basically you're a salesperson, right? You're bringing in commissions. That's the whole game. But I decided I wanted to focus initially I was focusing on trying to attract wealthy clients, and I had River Phoenix as one of my clients. I don't know, his brother is Joaquin, and I don't know if anybody remembers River, but River was acting before his younger brother Joaquin, and he was big. He was in Stand By Me was one of his big movies. My Private Idaho, I think, was another one, and he was up and coming. And but River had a penchant for speedballs, and so he, as you may know from the news when it happened, if you were around then, he was doing speedballs at his buddy Johnny Depp's club in Hollywood, the Viper Club, and he died on the sidewalk from an overdose. And so my big plans of, being his financial advisor and making, kind of like the guy who's the broker for Bill Gates makes pretty good coin, because he's scraping off a percentage or so of whatever Bill Gates has in assets. So I thought that's what I was going to do. But that particular event kind of threw my business into disarray. So at that point, I had already been trading a little bit for myself. I was doing pretty well. So I decided I was going to focus on stock trading and attract clients who wanted to trade stocks. There was one other guy in the office doing that. He had Metastock. I don't know if you remember, that was probably, I don't know if it's still around, but that was one of the first charting softwares out there, analytics software.
Not to be confused with Facebook, right?
No, not at all. No, it was just like one of the original stock analysis programs. So he had charts and everything, but he would prospect for people who were interested in trading stocks. And so I started doing that. And one of the brokers in the office was an old guy named Harry Wayne. And Harry had these big ONeil database books on his desk. And so I went over one day and to talk to him. He was about 85 at the time, getting ready to retire. So he had these big books, and I said, those are ONeil. And I just read ONeil's book. And he's like, yeah, I was Bill O'Neill's first boss. So he actually hired Bill O'Neill into Hayden Stone back in the 50s. Wow. And at this point, Harry was 85. And so Harry had these big chart books, they're like 600, 700 pages each. And so he would let me take them home and I'd go through them. And in exchange for letting me look at the books, I would give him some stock ideas. I did pretty well with that. So when he retired, he opened an account with me. And at that point, I had moved to Payne Weber, where I became one of the top 100 brokers in the Payne Weber system. But Harry did well enough with me that he showed Bill O'Neill his statements. And so then Bill O'Neill was looking for someone to run his institutional services group. And I was called into his office one day to come and visit him. And I wasn't sure what that was all about. And I found out he made me an offer, and the rest is history. So, and that's how I got there. And so I worked there for a few years, and I did very well. Was one of the top internal portfolio managers for the firm. He would give you a chunk of money and pay you 10% of the profits and turn you loose, and didn't bug you at all, So I did that until 2005, and then I left. At that point, it was pretty much a matter of, well, how much is enough? When you have enough money and you've made tons of money, you can kind of back off and do your own thing. So I messed around, tried to run hedge funds. I figured out that I'm not very good running money with people looking over my shoulder. Mm-hmm. When I ran money for Bill, you never heard a peep from him. But when I tried running hedge funds, didn't do very well with that. And so blew that off in 2010, 2011, somewhere in there, and just focused on writing about the markets, because I love to write. And when I was younger, I fancied myself a sort of a wannabe author, like a John Steinbeck, or Grisham, or whoever, and so this is a way for me to pursue that, but to write about something I knew about, which was the stock market. And so started 2 websites back then, and now that's what I do. I run the 2 websites. I trade my own money, and basically these days what I try to do is create a product in my websites that is extremely affordable. So for example, I've charged $49.95 for the Gilmore report since I started it in 2008. That's still what it costs for the basic report. And then for another, I don't know, $25 a month, I'll do 2 to 3 video reports and all sorts of other fun stuff, blog comment pages, all this other stuff. People can ask me questions, whatnot. So it's very low priced, And so I'm trying to create something that's accessible to the average person who's starting out as an investor without gouging them. I mean, I've always figured, okay, if you're such a great trader, why do you need to charge people $500, $1,000 for your stuff? And maybe it is that good. But at the same time, I've always felt that as people who get to trade in the markets and make the kind of money that we do, just sitting on your butt, clicking away at your computer screen, right? Maybe occasionally screaming at it. And you can make a lot of money just doing that.
No,
You
great
should,
point.
you're very lucky to do that. Okay. And if you think about it, it's kind of like Gordon Gekko said, I create nothing, I own. And to some extent, traders do that. But again, we can get into the whole argument about whether traders have a function in, let's say, investment society, because we add liquidity to the markets, and so the whole machinery works very well that way. We're the lubrication, right, that greases it all and provides liquidity. So,
Well, Gil, if
go
I
ahead.
may, if I may, what I'd love to know is, how do you think other than just reading Bill O'Neill's book, How to Make, I'm assuming it was one of the early versions of How to Make Money in Stocks.
The first one, the white one.
Yeah, the first one. All right, the first edition. I think I've got the fourth on the shelf or something like that. So, but what's interesting to me is like how you made it back then. And you said you didn't like sales. You really
not being a pure salesman. I was sort of like the no moose for you broker. If clients ticked me off or didn't really want to listen to me, or they wanted to get into a pissing match with me, which it was always the men who wanted to do that. So naturally over time, I had more women clients because they're much more open-minded and they work better as a team. But if somebody was disagreeable, then I just fired them. I didn't really care. I wasn't putting on sales pitches. My basic cold calling line was just to go through these, stacks of phone numbers and cold call and just ask people to use a broker right now to trade stocks. If they said no, then went out to the next person. But if they said yes, then that was my approach as well. Would you be open to hearing about a certain approach that I use that has worked well? Right. Maybe you don't like what you're doing now. And that was basically it was very straightforward. I'm not a very salesy person. So
would you consider yourself then back then like a very early adopter of the CanSlim method?
Probably, I guess that was 1991, I guess. Yeah, back then it was sort of, ONeil was something of a pariah. And I remember reading the book, and some of the old timers in the Merrill Lynch Beverly Hills office would come by. It's like, oh, you're getting into those over-the-counter stocks, and that unlisted stuff, and you're a momentum guy and this and that. I say, oh, no, I don't know. I'm just trying to make money. It's like, I don't know what I am, a momentum guy or whatever. But I got a lot of flack for that. And people would say, oh, yeah, can slim. Yeah, well, I know all about that because you can slim your portfolio down using that system. So there's a lot of that going on. But I made it work, and as a broker, I made it work. And then I did well enough with my key clients like Harry Wayne that Bill O'Neil comes along and recruits me. So, but when I went to work for Bill, I was very interested in learning more about his process. In other words, how he came to his conclusions, his statistical work in terms of determining what patterns and what sorts of setups worked and what didn't. And that's when I found out there really wasn't much behind any of it in that regard, because Bill is an incredible instinctual trader. I mean, he operates on his instincts. He has an incredible nose for the market. And I think CanSlim is just his way of somehow trying to codify it in a way that other people could understand it, because he did recognize that the stock market provides average people with an incredible opportunity to save money and then grow that money at a very rapid clip if you invest in the right stocks and create wealth. So he wanted to do that for the little person. And after a while, they were selling the paper for, I forget what, $200 a year. And then they had the weekend webinars or seminars, rather, I should say, the live seminars with Bill for like $695. And then in the early 2000s, they had a marketing consulting firm come in and they started doing these $15,000 weekend seminars. And it struck me that they'd kind of lost their way. In other words, to me, Bill was trying to help out the little guy, and all of a sudden the marketeers were telling him he needed to exploit your customer base. And there are other things I didn't really care for. And instead of whining about it, I just left.
Gotcha.
So,
yeah.
But that's how that all progressed. But I did very well there. And, no, I don't think Bill's had any other chief market strategists. And I know for a fact that nobody else has ever authored a book with Bill O'Neil, which I did the first short selling book, How to Make Money Selling Stocks Short.
Yep. So, it's one of my favorites, along with your personal,
or the more recent one is actually the better one because it's updated, and it actually covers daily chart, uses daily charts to cover the methods, because that's really where the rubber meets the road. Dealing in sort of the big picture weekly charts is not really practical in terms of teaching people the mechanics of short selling.
Well, what if we, if you don't mind, Gil, what if we step back a little bit to that era and try to maybe make some connections with what most of the newer traders these days that have come in maybe say the COVID pandemic market, maybe starting in like the 2020s. What similarities do you see or have you seen in this most recent bull market with what you
2000?
experienced living in the 2000s? Yeah, trading.
Yeah. Oh, definitely. This is definitely a similar type of bubble market, and there's so many things that are similar about it. It's scary. And the first one being that I remember back in 99, 2000, Bill ONeil telling me, this is quite a market. It's going to end very badly, but you make a lot of money. And if you're lucky, in 20 years, you'll see another one. And sure enough, about 20 years later, here comes the 2020, what would you say, 2020 to 2021 market. That was a nutso bull market, but much different than 99, 2000, in that a lot of stranger things were moving and stranger things were happening, like the meme stocks. And then you had all the crypto speculation going on. And then you have some of these figures like Kathy Woods, who's to me sort of embodies all of the hotshot money managers back in 2000, who held on to their .coms even as they blew up, because these were going to be the next big thing, and they knew it and nobody else did, and they all blew up. And so there's so much of it is similar. And also the retail crowd, you'll see, I remember last year seeing a few YouTube videos, like there was this couple, they looked like they came right off the set of Jersey Shore. And the guy's like, well, let me tell you about my stock market investing method. I see a stock, and if it's going up, I buy it. And I keep holding it until it stops going up, and then I sell it. And I'm thinking, if it's become that easy, then that's telling you something. But it definitely, you had this huge retail phenomenon, and all that money that came pouring in from the pandemic. I don't know, what do you call it, welfare bills that they passed, or the stimmy checks, all of that. People, I think, were trading and using options, so they're getting a lot of leverage. So I think a lot of the weird moves that you've gotten, where you'll see something run up for a short period of time and then just completely blow up, I think all of that is call buying that drives it. And then, of course, the market makers have to, as it starts going up, you get the gamma squeeze and so on. And they've all got to start buying the stock too. And so that just creates this big snowballing effect. And then it runs its course. And when it does, there's an air pocket below it, and everything just comes crashing down. And it seemed like that was much more extreme than what we had in 2000.
Okay.
If I could put it that way. And I'm sure the old timers back then wouldn't say it was orderly, but to me, on a relative basis, it seemed a little more orderly than today's action, because you'll see stocks running up, 50% in one day, and then the next day they're down 30%. So dealing with something like that, it's very difficult. But if you're just dumb and long, if you're Mo from Jersey Shore, you just buy stock and you sit there with it, and you get lucky. And then, of course, you sit there too long, you lose everything. I think a lot of people experience that lately. But
and I mean, that's a really interesting point. And honestly, the only thing I really remember about the 2000 market was just that my dad had made a considerable amount of money as a newbie retail trader, and then told me a couple of years later that he'd kind of lost most of it, I guess, on the downswing. But having traded this current market, and ever since about 2018 when I got started and followed you, I'm curious, like, how has your style shifted since then, and maybe what influences have you had on your style? Was there the presence of QE back then? Did you trust that market more than maybe you trusted this market? Are you more of a shorter term trader versus, a longer term position trader back then? How has your style changed?
Well, back then, the markets trended a little better than they have more recently. But I mean, over the last, say, 10 years, when I stopped running hedge funds and started running my own money and throwing up triple-digit returns again, the way I was doing it was by holding positions for the most part 3 to 6 months. So more recently, a lot of my tactics have changed over the last, say, 3 years or so, because the market has become more of a contrarian type market, more of a range-bound market at times. And I think that's because a lot of it is just run by algos, and you have the ETFs in there and the algos, the rebalancing that goes on. I think creates boundaries. And so that's why you'll see double top breakouts tend to work very well as short sale setups,
Mhm.
and undercuts of prior lows and bases where the stock turns and then rallies back above the prior lows. That I use that as a long entry point, and that works pretty well. And again, it's this sort of reversion to the mean type stuff,
Okay.
where you're trading at the edges rather than, breakout to new highs. In the old days, you'd load up on that. Now, if you do that, you're likely to get your head ripped off the next day. So that's something that's definitely changed more recently. And the other thing I would point out is that sometimes you can become a victim of your, say, length of experience. Because I remember back in '99 when I was in my late 30s, and I'm buying these .com names like CNET, and VeriSign wasn't a .com name, but it was a hot one. But there's a bunch of stuff like that. And the older guys who had lived through the '70s and the '80s, they couldn't bring themselves to buy it, and they would keep saying, that stuff is nuts. You guys buying that stuff, you're going to get killed.
Mm.
And as it turned out, we just sold into the climax top in March of 2000. It was pretty textbook, and so we got out pretty well. But yeah, had we sat around too long, we would have gotten killed, and a lot of people did. But those old timers never really exploited that 99 2000 market, because their own psychology and their own experience had sort of created this sort of unease with the whole situation. And it's interesting because I actually, I try to look at myself very closely, my own psychology, and I can tell that I have this sort of unease with what's going on based on my experience, having lived through markets where stocks just blow to pieces almost on a moment's notice, March 2000 being one of them. And then, of course, you have the 2008 financial crisis. So you go through some periods like that in your career. And when you see something that seems to be off the charts relative to anything you've seen before, and sure, in '99, 2000, the old timers had never seen that much liquidity. They had never seen a .com boom, a hot thematic like that was just bringing in retail money like nobody's business, and everybody was becoming a day trader and quitting the job, right? Um, so I think today that sort of, I've noticed I sort of have that hesitancy, and so I'm not able to exploit it as well as I could have. So something to think about. We talk about it in the book that you mentioned, In the Cockpit with the ONeil Disciples, where we actually talk about that concept, where the old timers in '99 2000 couldn't exploit it because their psychology had already been somewhat molded in a way that they couldn't quickly grasp onto it. Whereas we were like, yeah, just jump in, everything's great, life is easy, you make tons of money, you don't have to think. Of course, after that was all done, I had to learn, sometimes painfully, that I could not take the type of drawdowns I was able to take in '99 2000 because the market was not that forgiving. It wouldn't snap back. And so, by the time we get to 2020, 2021, a lot of it's just kind of weird to me, and difficult in that regard. So, but we talk about that in the cockpit, how you have to think about what did you grow up in, what type of environment. And if you think about it, I started in the early '90s, and the 1990s were essentially the parabolic bull market, kind of the way the 2010s have been. And so, we're sort of products of the environment in which we started. So you say you started in 2018, right?
Right.
So you've only seen this crazy market. So that's your perspective.
Right.
So, but what I would tell someone like you is what you should probably do is go back and study the last 20 years, and see what has happened and gain some perspective, because there are a lot of people who've made a lot of money, or they were last year, and they're not anymore. They're getting chopped up, and they got to pay taxes that they didn't think about. So,
Great point. Yeah, and that is interesting from my own perspective, is that I actually had kind of a difficult time trusting the market of 2020, 2021, just because of the level of, like you were saying, like the level of volatility, the level of liquidity that was just sloshing around in there. And so I might take a couple of positions and sell, a couple of days later on some really big moves, and then they end up going like 1x, 2x, 3x from where I sold.
Yeah, I've done that one too, because just the magnitude is insane, and the velocity. How quickly these things move. I mean, you look at some certain things like QuantumScape, for example, was one stock. You buy that one and you're up, 50% in a week, and you think you're a genius, and then it goes up 400% over the next week. So
exactly.
But it's been that kind of a market, but it is entirely a function of the tremendous amount of liquidity that is in the system. And, that is starting to lead to instability. I think that's starting to bear on the markets currently.
Well, yeah, and it reminds me a lot of like parenthood. I've got a 13-year-old son, and he loves going to the amusement parks and riding the things that just spin you round and round until you want to puke, or do the ones that ride that go straight up and back down. And I used to could ride those, but I'm one and done now. Like, he asks me to jump on there, and I'm literally trying to catch my breath after, for the next couple of hours while he's running around riding those rides.
Uh-huh.
It kind of reminds me too of the guy that actually got me into trading. He was an old hedge fund manager, or he owned his own hedge fund. And his name was Frank Husick. He's got a winery out in Napa now, and I was in the wine business.
That name's familiar. Okay.
Maybe so. Yeah, he's from the San Francisco area and things like that. And he ended up getting married, and he started his own winery, bought a piece of land in Stag's Leap. And I was a sommelier at the time, working in the wine sales business. And he would come to town, and I would put together some dinners at some of the local Atlanta country clubs, and we would sell wine out the back door.
Mm-hmm.
It's just kind of my sales background there. But every time we would drive around Atlanta, he'd say, "John, you ought to get into the stock market." And How to Make Money in Stocks was the first book he told me to buy.
Mm-hmm.
But there was one thing that he said back then, and I would always bug him about this, and I still chat with him from time to time. And he said, there are bold traders and there are old traders, but there are no old, bold traders. So maybe that's got something to do with it.
I don't know. I like to think of myself as old and bold.
I think you are, Gil, because a lot of times I see some of your plays that you share on Twitter, and I'd love for you to talk about this, but maybe you're not holding for the long term, but sometimes I hear you going like 400% short
when I'm shorting. Yeah.
On something, right off the open. And, that's a bold play.
Yeah. But that depends on the position of the market. So if you've been rallying for a period of time and there's an inflection point and you're able to pick that up in real time, I will come in and pound it right there, but I run it very tight so that I can be out very quickly if it doesn't turn my way. But that's essentially what I do on the short side. So I'm looking to hit rallies.
Well, do you have any examples?
Pardon me?
Do you have any examples you'd like to share with us, or anything chart wise?
Yeah. I mean, let me, what do you want to do?
Love to kind of give viewers an idea of just some of the high level overview.
I mean, you look at a stock like Chewy, for example.
Okay.
CHWY. I don't know if you can pull charts up. This stock, they're going to make, I don't know, 2 cents a share next year. And this market is plagued with infinite PE or near infinite PE stocks. And when you have an environment where interest rates are rising, whether the Fed is going to start raising interest rates, but somehow I have a hard time believing that, or the market starts raising interest rates. So we've seen the 10-year Treasury yield run up to 2% recently. We closed today at 1.969%. But in essence, you're in a rising interest rate environment. And when infinite or near infinite PE stocks, and even high PE stocks, or stocks that have PEs that are high, or have had PE expansions that are high relative to historical norms, those are going to begin to contract. And so back in November, I started talking about shorting a lot of these infinite PE cloud names, and all of those rolled over and have continued lower since then. So just real quickly, let me see if I'm trying to remember. If you look at, say, Bill.com, that one started to roll over in November. And so you can see the peak here. So here you have a situation where the stock has had a gap up move on a breakout. Now, when this happens in this market, a lot of times breakouts don't really go anywhere. You see this one here and it just chops around forever, and then it gaps up again after earnings. But this time what happens is it fails, and it fails rather quickly. So once it comes back through the breakout point and the 20-day moving average, which is the green moving average there, that's where I'll hit it. And so I'll just come after it right there, and I'll come after it in size. And oftentimes that will be when the market is rolling over too. So if we have an up opening, or even if the market's flat, but I see this start to trigger, that's where I'll come after it. And I keep things pretty tight, because once it breaks the 20-day line, I'm on it. And if it pushes back above the 20-day line or whatever I've designated as, say, a 1 to 3% maximum stop on the upside, I'll just cover it. And then if it does break it again, I will come after it again. So you can see this is where you got the velocity here. And then now you're chopping around, you form a bear flag in here. And then more recently, you have broken down in January. And now some of these are trying to bottom. So more recently, last week, exactly a week and a day ago, Chewy.com. Now, this is a online pet food company. They're going to make 2 cents a share next year. So it's an infinite PE name. And you have a bunch of analysts raising their price targets on it. And then you finally get above the 50-day line here. That's the blue moving average. Okay. And what I'll do is, as soon as it starts to roll over in here, so I'm going to track it in here. And notice how this black moving average, that's a 65-day exponential. If it breaks away from that or busts the 50-day line, I'm going to come after it right there. And then you get a nice 4-day move. Now, from there, you undercut this low today. So you undercut this low over here on the left side. I know I'm making a mess, but try and follow me if you can. This low here. So you undercut it today. That's a cover point. So if you read the book, Short Selling with the ONeil Disciples, I talk about how I use that as a cover point. So that's essentially a 5-day trade. Okay, and that's it. I'll come in heavy on it, and I won't carry a heavy position overnight, but I will do what I call campaigning the stock, where I will either cover it at the end of the day, and you can see how this will work in something like this. And mainly I did this because I don't trust the market with respect to how it can gap against you, or suddenly start going the other way overnight. And so what happens here is, you can see that you break down here, and then the next day you open roughly even. So you can re-enter the position, and then you cover at the close. And the next day you can re-enter here, and then you cover at the close. And so this one's pretty uniform. They don't always work that way. But when they do, I can work a big position intraday where, let's say I'm going to go 150, 200% short in this stock alone. But by the end of the day, I can drop it down to, say, 25, 30%. And then the next morning I can put it on big again, because it hasn't really change from where it closed the previous day. You follow me? So I call that campaigning a stock on the short side, and that's how I will work a big position.
What I love about
loading
this,
it up in the morning. So
what I love about this is like the macro picture here. Like, you're using the daily, it seems like, to kind of get your levels. So, whether it was Bill.com, you were looking for that break of a key moving average like the 20. Not only that, but I kind of noticed like it was about to fill the gap from that prior gap day that you mentioned. And so it was just kind of like a perfect setup.
Yeah.
There it is.
Yeah, exactly. And when it did fill the gap, and it held there for a little bit. But notice how the green 20-day moving average then serves as resistance. And that's a classic late stage failed base type of setup, where the initial say indication of potential failure occurs, number one, when it breaks the 20-day line, and that will generally coincide with number two, it drops back below the prior base breakout point, or the top of the prior base, which in this case would be this point here. So once it does that, now usually what they do is they'll go down to the 50-day, and it pretty much did that. And then you'll get some rallies back up into the 20-day, and you can come after it in there. And that's when you got the higher velocity break back in January. And a lot of these just really, they really came apart. Like also Cloudflare was another one. But these were big leaders. And you can see this one actually, same thing. Notice how this one blew apart in November. And once it broke the 20-day line here, that was really where I start my antenna go up, and I'm watching it. So on a day like this, where you have a very low volume rally, you can see the volume bar is very low. It's almost, you can hardly see it. Right. It looks like stubble, it pushes above the 20-day line. My antenna go up, because that's the point where I'm looking to just hammer this thing with a huge position, and able to do that there. And then the thing broke hard. So so that's basically what I'm doing. I'm using these very specific entries, and I'm using very tight stops, and I'm just coming in and hammering them big time. And usually I want to have the market moving with me. So market context has to be bearish as well. So, a lot of times these things will start to break down. They'll be hovering up, they'll be in a 2-day rally like this one was in here. And let me get my crosshairs, like this one was in here. you get a 2-day rally, but then you get the low volume. I call that a voodoo day, volume dry up, VDU, then it becomes voodoo, after a couple of martinis, and that's how the name occurred. But in any case, you can see that there are specific inflection points that I'm looking for, and that's where I come in heavy. It's not like I just come in anywhere and like, yeah, let's do a 200% position. No,
Yeah.
it has to be very well considered and also managed very tightly, because if it doesn't work and the market suddenly decides it's going to rip higher, you're going to get your face ripped off. So, but that's the way I like to do it. I mean, at this point in my career, most of it is fun, and I don't need to make money. So, I'm already rich, and I can experiment a little bit and not feel like I'm under any pressure to perform, because I'm not selling performance. I'm just doing my thing, and what I learn, I can then use to teach others and hopefully help them out. That's really my main goal these days, to take what I know. And yeah, I have fun trading, and nothing's more fun than making money. That's how you keep score. But to me, it's not the be all end all of my existence. And teaching people these methods is really what I want to do. So, the thing that makes my day these days is when somebody emails me and they say, Gil, I've been investing for 7 years. I haven't made a dime the whole time. Done nothing but lost money. And then last year I found your website, and this year I'm up 60%.
Yeah, that's awesome.
And that sort of thing makes my day, because it tells you that you become useful as a human being. That, like they say, no man, no woman is an island. And I think you do have to live your life that way, that when you've been fortunate to benefit from all this stuff and you do have knowledge that you can pass on, you should do your part to help others. And like I said, I try to keep everything pretty reasonably low priced, and basically that's what I'm doing. So, in a sense, I don't have the same emotional stake that I had when I was first starting out, with my $3,000 back in 1990, 91. And
okay.
So that, that's why I can do this sort of thing.
Well, I think what's really cool about your strategy, Gil, and this coming from a younger trader like me, is, I really picked up on your, like you were saying, what you wanted to pick up on from Bill ONeil, like just watching you in with your service actually was the intuition that you share. Like, it's just, to me, it was like second to none. It was amazing. And so, to be able to see that and then, affordably implement those ideas into your own trading plans, your own trading strategies is really priceless. One thing that I was going to ask you about, if you wanted to, and I know we're kind of coming up on time here, is we've kind of looked at the macro picture here. Do you have anything like with a 520 or the 620 MACD on a 5-minute chart, like how you dial into those on an intraday level? Or is that giving away too much?
You know what? Let me bring out my e-signal. Like today, I was actually shorting this one, SSR Mining. That's a double top short. You can see this morning it rallied above. This left side peak is 2005 or 2006. So this morning you rallied to 2026, and then you reversed back through this left side peak, and that was a short sell entry. So I went in pretty heavy. Let me see how many shares that would be. About a 200% position, and then it closed. It broke down to like 1920, and I covered most of it. And I'm holding a tiny position, maybe about 25% right now. See what happens tomorrow. I think gold might come in a little more, because this Ukrainian thing is not really. I mean, it is what it is, but it's not turning into World War III. And I think that's what the gold bid took it up to, 1976 today on gold an ounce. And then you reverse, and I think you're somewhere around 1900 right now. But anyways,
are you treating that like an undercut and rally reverse? Is
today,
that kind of?
It's sort of the inverse of it if you think about it. This is a candlestick chart. So, with this one, I wasn't using my 620 chart. I was just doing a straight double top sort of situation here. But another one, let's see if I can come up with, I use, what I like to do with my 620 chart. This is basically a 5-minute chart, and it has, 6-period moving average, that's orange, a 20-period moving average, that's blue. And then the MACD is set to 6 and 20. So the fast line is the orange 6, and the slow line is the blue 20. And then the other settings are 10C, I think they are on e-signal. But that's essentially what I'm doing here. And I use this for intraday timing. You can actually see that this guy triggered a sell signal here early in the day as he was dropping below the 2005 price point. So that would have been, if you're looking at it here, see if I can draw this straight. Yeah, you can see early in the day, right at the open, you opened up here and then immediately you dropped. So boom, you hit it, you get one rally up close to it. So it did get stopped out, hung out with it, and then finally it broke. And at that point, you get this little cross here, so you can pretty much cover most of the position. And if I decide I want to hold some of it overnight, I'll do that. But essentially, that's my timing tool. And one of my favorite things to use it with is the UVXY, the Ultra VIX short-term futures ETF. And you can see this morning we came in and you know what? Let me do something here real quick. Okay, yeah, and you can see, okay, so the lighter color is the pre-open session. So I was long some of these inverse ETFs like the SOXS, for example. And early in the morning, what I noticed is I get up at 4 a.m., so that's here. And I noticed it's trending pretty nicely. And then just before the open, you finally get a moving average cross about a half hour before the open. The MACD had already been trending down. So I basically blew it out and took my profit. The market gap down 700 points or something like that. But in this case, the 620 chart told me to cover before the open. And I just follow it. If it had given me a long entry signal later, then I would have followed that. But all I know is I bought this a few days ago under $4 in pretty large position, and you're up 15% in a few days, and it's leveraged. So I'm going to take it. Actually, what was it up? So you go from like 370 to what do we hit today? 550. That's about where I blew out. What is that percentage wise? I don't know. That's more like what? 30, 35,
35%, maybe?
Yeah. So, so at that point, things are getting a bit piggy and we're gapping down today. The other thing that I thought was interesting is yesterday, IBD, which had been adamantly declaring that the market was a confirmed uptrend under pressure all the way down since early January, finally declared that we are now in a market correction. So, thank you, Captain Obvious, on that one. Also, all the pundits on cable financial TV, which I just watch for, number one, entertainment value and also for contrarian indicators, they were all talking about how, oh my God, now the Dow is in correction territory, the S&P is in correction territory, everybody's in correction territory. And by that time, I'm thinking, okay, so that means it's become pretty obvious. So at that point, I've just got my antenna up and I'm watching my 620s. You show me a reason to sell and take a profit like that, I'm going to take it. So in this case, the 620 chart helped me out with that timing, and I love to use it, also for buying, picking off buy points. Because if you look at this, would have been yesterday, right at the open, you had a very nice MACD cross here at about 440. So one could have picked it up there. You dropped here. It's possible you could have gone out on this sell signal and then come back in here. But generally what I do, if I catch an inflection like here early in the day, I'll sit with it as long as it doesn't drop back to my entry. So in this case, it didn't. And but then you get this other signal, and then I can just load it up again. And so I'm using this to help me manage the position. Now, here's the interesting thing. A lot of people like to get hung up on things like this as being trading systems. And I haven't spent a lot of time back testing it per se, but I have used it for a long time. And I originally was using it to trade Forex, using this basic configuration on a 5-minute chart. And then after a while, I decided I needed something to kind of keep me in my lane, so to speak, stay between the lines when I'm short selling or trying to run, big positions very quickly. And so I decided I'll start using this. But the thing is, you can use a 620, you can change it to be an 824 or 927, and you roughly get the same signals. Obviously, the bigger the numbers, the values that you use, the signals are going to be a little slower.
Right.
But it's just a basic tool. And I'm looking at where the stock is on the daily chart. So if we go back to this SSRM example today, okay, first of all, what we noted at the open is right away you had a sell signal just before the open, right? And it opened above that previous high on the daily chart. And if we segue back to the daily chart, within the context of what's going on in the daily chart, you have this sell signal here. And that coincides precisely with the stock also coming back below this double top area here.
Right. Are you hammering the bid then right off the open, or?
I'm just hitting it. Yeah.
Yeah.
And if it keeps pushing me, I'll just back off. But my thinking generally when I take big positions is I should get some love right away.
Yeah.
It should be a short date and then, off to my place. But
So you see the 620 crossing on the chart, you see the 620 crossing on the MACD, you're hammering the
yeah,
bid.
so the MACD cross here coincides precisely with the peak rolling back through the peak on the left side here. We'll see if this works. I mean, it's only going to work if gold keeps coming in. So
right.
Otherwise, I made pretty good money on this. I'm holding a very small position relative. I mean, if you figure I've got 30% position roughly right now, and I was running a 200% position, maybe a little bigger during the day today. Mm-hmm. It's considerably smaller than what I was working during the day. So I did pretty well with that. And now we'll just see how this plays out and whether I end up loading up again tomorrow. So it may not, but I think the other thing with having such an aggressive approach is that you have to be willing to shift very quickly. If you're a bit stubborn or slow, it's going to hurt. But at this point in my life, in my career, like I said, I'm not under pressure to make a lot of money or anything like that. And so, I just react, boom, boom, no skin off my teeth, as my dad used to say.
Yeah.
And just move with it, flow with it, dance with it, and be more focused with that whole process and the dance, as I like to call it, rather than trying to fight it one way or the other. So, and this is the way I do it. And you usually find a couple, 3 examples every day that work pretty well. And so that's pretty much the modus operandi these days.
I appreciate you sharing that, Gil. Yeah, and I think it gives us, a lot of insight into how you view the markets. And if anybody wants more in depth, they can subscribe to your affordable service. Just before we wrap things up here, you mentioned you wake up at 4 a.m. because you're a West Coast guy.
Yeah.
Just wanted to ask you, how important has routine been in your life? Because you've been doing this for what, 30 plus years?
Almost 32, I think.
32 years now. Yeah. I mean, has that been kind of like a consistent thing for you? Waking up, doing up some, and waking up early. Obviously, you've been West Coast for most of this time. How important is routine for a trader?
I think it depends on the person themselves. What are you oriented towards? I'm sort of I'm addicted to it. I'm fascinated by the whole realm of investing. I mean, the fact, as I already said before, how fortunate we are to be able to make this kind of money just sitting on our butts, clicking away on our PCs, but also being in the center of everything that's going on in the economy, in technology and innovation, in everything else, And so, like John Lennon wrote, I'm just sitting here watching the wheels go round and round, and that's what's so fascinating. I mean, today, the thing in Ukraine, it's like trying to figure out, okay, is this big? Is it a ruse? Is it a head fake? What is going on? What's it going to affect? How is it going to affect it? One reason I thought gold was a short today was because of how extended it got. And I never buy precious metals into strength. I'm always buying them on weakness. So we were buying the metals for position accounts, or I run several accounts. So the stuff I'm showing you here is for my Nutso account, but I have positional accounts that operate more slowly. And we have long gold and silver from a couple of months ago when they bottomed out. I'm trying to remember exactly where those were, but in any case, I buy those on undercut and rally moves. You go back a couple of months, you'll see those in both the GLD and the SLV, but I use these Sprott funds since they're directly redeemable into
like PSLV,
PHYS. Yeah, I favor those. They're very liquid. So that's what's going on right now, and we'll see how all this pans out. I think the Fed is stuck between a stagflationary rock and hard place, where I don't think they can raise rates. I think a lot of that's talk, and I sometimes feel like the Biden administration goaded the Russians into invading Ukraine to some extent, and that's maybe because they want that. Maybe they need an excuse for another round of QE. So
now you've called that an alibi before, if I'm not mistaken. Is
what I call alibi selling? Yeah, and it's something Bill ONeil told me about. When the big money wants to get out of the market, they will sell. You'll have some news event that will knock the market down. So we can go all the way back to Thanksgiving, when the Omicron, which essentially over glorified cold, it's like a cold with a PR agency. When that came out, it's, oh my God, it's a new variant, and like aliens from another planet, when COVID mutates, and supposedly it grows 2 more heads or something, but the reality is over time a virus will mutate and evolve so that it doesn't kill off its host. It does become more contagious. And so that sent the market down the day after Thanksgiving. And that struck me as an alibi selling episode where, oh my God, there's this news and we're going to sell. And so they will sell because their operations, when they want to get out of the market, it's going to take them days and weeks and sometimes months. Okay. So they got to work it. So, yeah, they'll sell on the news, get rid of some stock. And then what happened over the weekend is the whole Omicron thing kind of settled down, right? Mm-hmm. And then so you had the rally on Monday, and then what happens? It rallies for a little bit, and then boom, they hit it again. So what they do is they hit the initial news. Then when the news is mitigated, turns out to be not as bad as originally thought, then the market will rally and they'll come and hit it again. And Bill used to call that alibi selling. So they wait for the alibi and they sell, and then they wait for the alibi to run its course, and then when the rally comes again, they sell again. And so I think you've seen that with some of this over the past week or so. Didn't we have a big rally on Monday morning or last Monday or something because Putin said something that he thinks Biden is cute, or I don't know.
I'm not sure about that. I know we had,
but I mean, it's always somebody said this. Over the weekend, you were getting, Russians say they're open to diplomacy and blah, blah, blah. It kind of reminds me when Trump was putting tariffs on China, they agreed to have a phone call tomorrow, the market would rally, so all that kind of stuff. But that seems to be with what's going on now, because I don't think the Ukrainian issue is really the crux of the markets issue. I think that what the Fed is doing in the deliquification of the market, where all this liquidity is now starting to dry up. And if they start lowering, cutting back or trimming their balance sheet, that's going to definitely have an effect. And they did say in the last meeting minutes that they believe they should start substantially decreasing their balance sheet. So we'll see how this plays out. But I think that's really the market's problem. And I do think that the increase in interest rates we've seen over the past few months, with the 10-year heading up to 2%, I think it was starting out in early fall, that has sent a lot of these infinite PE and high PE expansion names crashing to earth. And you've seen that across the board everywhere. I mean, ask the Ark Management people. So they had a rough time. I mean, but they don't seem to understand the basic concept of PE expansions and PE contractions and how those are related to liquidity in the market. And so when liquidity starts to reverse course and it inflects back the other way, starts decreasing, then those PE expansions are going to reverse. And as Bill ONeil used to say to me, when those PE expansions start to contract, people will be shocked at how fast and how low stocks go. And that's what you've seen. I mean, I see Cathie Wood on TV, and she looks like she's dazed and confused and doing her best to sound coherent. But it is shocking.
It has been shocking.
But if you've been around the block a few times, you saw this happen in 2000. It's the same. They're playing the same loop tape, and you have the same anecdotes that go along with it. The hotshot money managers that were flashes in the pans and didn't understand that what they were experiencing was randomness, fooled by randomness. You read that book by Nassim Taleb?
Yep, I've got it on the shelf.
And what he says is exactly right. I recognized a while ago that, in 99, I made 1,008%. So I'm an incredible genius, aren't I? No, what happened really is I just jumped on the wave. In October of 1999, back when follow-through days used to work better than they do now, you got a follow-through day, I think it was October 27th, I was up 35%. All I did was get long a bunch of stuff, okay? And I sat with them. And by the end of the year, I'm up 1,008%. Now, was that due to my brilliance? No, it was the size of the wave that I was riding. And so I ran into what was a random event, which was the bull bubble market, .com market of 99, 2000. And then more recently, you have what is a random event, and it's a confluence of random events. The pandemic combined with all the stimulus and the money printing that's been going on created the perfect storm for a crazy bull market or a crazy tidal wave that people like Cathie Wood and others, she's not the only one. I don't mean to just pick on her. And again, it's not personal. Somebody tweeted to me, "Oh, I think you don't like Cathie Wood because you've been short Tesla." It's like, no, I've been long Tesla at the right time and shorted at the right time.
Right.
So it's nothing personal, but she's not the only person who's experienced this. A lot of retail investors have, but very similar stuff. And it's funny, history doesn't repeat, but it rhymes. And you're definitely seeing something today that rhymes with 2000.
Well, I think that's a great way to end it right there, Gil. And your market analysis is always second to none. So I really appreciate you coming on. Really just an honor to be able to speak with one of my mentors in the market. And I know
I appreciate that. And I am in turn honored that you consider me a mentor.
Well, tell us real quickly before we go, how can our viewers find you?
Well, you can catch me on Twitter at Gilmo Report, GILMO Report. And you can check out the websites, gilmorereport.com and also virtueofselfishinvesting.com. I do that website with my colleague, Chris Catcher, who was also a portfolio manager back during the dot-com bubble. And those are the two places you can find my stuff.
Perfect. Thanks so much, Gil.
Thank you.
Hey, thanks so much for watching. If you enjoy our content, please subscribe to our channel and be sure to like our videos. Also, check out tradingsim.com/blog for more content.